If you're watching silver today and thinking, the fear is gone, so the metal is done, you're staring at the wrong screen. Because while Western retail traders are panic selling silver ETFs on a red candle, China is executing a slower, colder move, stepping down from U.S. debt toward the inputs that run the next industrial age. And the number that matters is not a headline, it's a line item. U.S. Treasury TIC data shows China's reported holdings of U.S. Treasury securities at 682.6 B at the end of November 2025, down from 688.7 B in October, levels the data hasn't seen since 2008. So when people say China sold $688 billion, correct the framing that 688 B is the size of the position. The signal is the direction, month after month. Now here's the twist. The West treats silver like a mood ring. Risk on, silver down. Risk off, silver up. A trade war cools, dump the ETF. China treats silver like a refinery input, a strategic component. The new oil for solar, electronics, medical hardware, and the power rails of AI data centers. So let's connect the chain in plain English. The paper loss that makes the move. Logical treasuries are safe only if you ignore duration math. If you bought bonds when yields were low and you reduce that position after yields rose, you don't exit at par. You exit through a discount. That's not a conspiracy. That's how bond prices work. And even if a central bank isn't trading like a hedge fund, shrinking a huge treasury book in a higher rate world means you are accepting, either realized or opportunity, losses to rotate into something else. So ask the strategic question. What is worth taking that pain for? The physical gain. The West doesn't price in a treasury as a promise. A bar of silver is a component. Treasuries sit on a statement and wait for policy. Silver sits inside products and gets pulled by factories. And in 2026, China is tightening the gates around several critical exports, including silver, authorizing only a limited list of companies to export silver for the 2026-2027 period. Read that again. Not banning silver, not confiscating silver, but controlling who can export it and under what approvals. That's how you corner a market in the real world. You don't need a villain meeting, you need allocation. Why this matters when the chart looks ugly. Here's where Western investors get emotionally trapped. They see a drop and say, silver failed. But a lot of the time, the drop is simply inventory transfer. Weak hands selling paper claims, strong hands checking deliverability. Because the real battle isn't the spot quote. It's who gets metal when supply turns conditional. And when exports are filtered through approvals and whitelists, the price can lag the shortage. That's the key lesson. Paper can trade down while physical availability quietly tightens. The 688B exit as a strategic message. Let's zoom out. Foreign holdings of U.S. Treasuries overall hit record highs in November 2025, even as China pulled back. That tells you something important. China can reduce exposure without crashing the market, because others step in, which means the move is not a tantrum, it's a reallocation. From U.S. promises to strategic inputs. If you're building solar at scale, electrifying transport, expanding grid hardware, and scaling AI infrastructure, you don't wake up and say, I hope the market has enough silver. You secure it, you approve it, you gate it. That's the entire play. The checklist, how to track this like an adult. If you want to stop being whiplashed by daily candles, watch the plumbing, TIC Table 5 each month, China's holdings trend line, export approval notices, and company whitelists for 2026, 2027. Physical lead times, back orders, delivery windows, allocation language, any widening gap between paper price and physical premiums. COMEX LBMA chatter focused on availability, not price. And if you want one sentence to remember, the West trades silver as a headline. China manages silver as a supply chain. So the next time you see panic selling in silver ETFs, don't ask only, where's the price going today? Ask the bigger question, who is positioning to control tomorrow's metal? If you want the follow-up video, comment one word. Delivery, and I'll map the next pressure points, without the hype, with the receipts. Corner. Doesn't mean buying the whole planet. People here corner the silver market, and imagine someone trying to purchase every ounce on Earth. That's not how modern markets get pinned. A corner happens when the marginal deliverable supply becomes controlled, when the last pool of available metal is no longer actually available. And there are 3 levers that do this without fireworks. Lever A, offtake contracts. Big buyers don't chase spot. They sign long-term supply agreements, often with priority clauses. When demand spikes, those contracts don't renegotiate, they absorb. Lever B, refining and processing bottlenecks. Raw material isn't the same thing as refined specification-grade metal. If refining capacity is booked, the paper supply can be huge while the usable supply is tight. Lever C, export permission, as a throttle. When exports are routed through approvals and whitelists, the global market is no longer a free-flowing pipe. It's a valve. That's why the Reuters report about a limited exporter list matters. It's a policy tool that can make availability conditional, even if production numbers look fine. The moment Western retail gets played, let me describe the trap. A Western retail trader buys a silver ETF because they want exposure. They're not taking delivery. They're not negotiating fabrication. They're not managing supply. So when the chart dips, they sell the easiest thing, the ETF. But that selling pressure is primarily a paper event. It can slam price in the short term, and it can create the illusion that demand vanished. Meanwhile, industrial users don't stop building solar lines because the candle is red. Procurement teams do the opposite. They use the dip to secure supply because their risk is not price, it's interruption. That is the difference between an investor mindset and an operator mindset. Operators ask, will I have it when I need it? Investors ask, will it go up this week? China's behavior is closer to the operator mindset because the state is planning industrial continuity. Why this exit story hits a 2026 nerve. The most important part of this story is psychological. For decades, the global system taught everyone the same reflex. Hold dollars, hold treasuries. That's the foundation. But the TIC table is showing China's treasury stack trending lower into the high 600B range. And whether you agree with their motives or not, the message is clear. They prefer optionality in real assets and supply chains over concentration in U.S. promises. The two endgames you need to hold in your head. Endgame. 1. Paper calm, physical tight. Headlines get soothing. Markets breathe, silver drifts, until a procurement shock hits, and the metal has to be sourced fast. That's when rules, approvals, and bottlenecks become the price. Endgame 2. Paper volatility, physical transfer. Big swings continue, not because the metal is broken, but because paper is the battlefield where inventory changes hands. It's noisy, it's emotional, and it's where retail is usually forced out at the worst moment. Not advice, just a framework for reading incentives. If you only remember one image, make it this. A Western trader watching a chart, a Chinese procurement officer watching a shipment schedule, same metal, two realities, and the reality that wins is the one that touches the physical world.